Hey, welcome back, guys. My name is Ochuko Jamaraye. If you're tuning in for the first time, I talk about a bunch of different stuff on this channel, but mainly I talk about ways that you can grow as a young adult, whether it's professionally, financially, and all of that. And a lot of this is coming from my personal experience. I'm sharing it with you so you can learn and grow. So today we'll be talking about finance, and I'll be speaking about stock trading. Now, here's a funny story. What if I told you that I bought Apple when it was at $100 per share? What if I told you I bought Tesla when it was at $200 a share? Just in comparison, these stocks have more than doubled from those prices that I just mentioned. I had these stocks and I made certain mistakes that personally kept me from optimizing my return on those investments. Now, there's reasons why that happened, and I'll talk about that. And that's what the topic of today's video is. Here are some of the best lessons that I've learned from my years of stock trading, and also three of my worst mistakes that I've made that could have really optimized my trading experience. So let's start with the good. Number one of the biggest advice that anyone will give you when it comes to stock trading is only trade the amount that you're okay losing. Nobody wants to lose money, but if you trade with an amount that's way beyond what you're comfortable losing, it becomes a much more stressful situation. So you take a little bit on the side. Personally, for me, I pay all of my expenses, any costs that I have. With the work that I do and with my expense, I do have a net amount that is available for me to save. What you want to do is just make a savings account and then put some of that aside for emergency funds. And then let's say 10%. 10% is what I started with. I took out 10% of my pay, and I just took that and I put it into the stock market. And that's what I used to trade with. It was 10%. It's not a major amount. It's something that if I lost was not going to be very impactful in my day-to-day expenses and just life in general. So I was okay with putting that amount in there. Worst case scenario, if I lose it all, I keep moving on. And, I'm not playing with my retirement money. Also, in terms of how you trade and trading with an amount you're okay losing, also think about the money that you put into your stock account, your trading account. Think of it as gone. That money no longer exists to you. It's money that is there. It's a number that you're just playing with. Don't think about it as money that can simply be taken out, because when you think of it as money that can simply be taken out, it tempts you to potentially take out that money, but you don't want to do that. There's nothing wrong with it. I mean, the goal is to make money and then use it for other expenses. But for me personally, what I've learned is that just putting that money in there, it's money I didn't need in the first place. So I just treat it as a savings account, as an emergency fund. So worst case scenario, I have a backup stash of money. If I've exhausted every single avenue of money that I have, at least I have my trading account where I can pull that money from. Other than that, if everything is still going fine with your work, leave that money there. Don't touch it. Just leave it there. Trade with it every now and then. If you need to pull out of the market, pull out and leave that money there. Treat it as a savings account, a stash for emergency fund. And then when the day does come that you want to make reward yourself with some purchase, yes, you can take some of that money out. But if you treat it as something that can easily be taken out, you run into that temptation of just taking it out on a whim. So that's number one. Before you go into this, just make sure that you're okay with that amount, playing with an amount that you're comfortable losing. Of course, you want to make more money, but just in case, nothing's guaranteed. Number two, using a compatible trading account. By compatible, I mean something that works best for you. Now, I think I was using E-Trade when I first started. There weren't a lot of options around. Robinhood was not around when I first started trading. A lot of these brokers, they had commissions for the trades that you did. So E-Trade, I believe, E-Trade, yeah. E-Trade had the lowest commission fee out of all of them. It was around $5 per transaction for whether you buy or you sell. So automatically that's $10 I'm losing from each trade, whether I sell or buy. Now, compared to the other ones, this was the lowest, so I went with that. That was my only reason I chose that platform. Now moving forward, we have a lot more platforms that are doing no commission. I believe TD Ameritrade, E-Trade as well. I believe they all have zero commission now on standard stock trading. But the king of for millennials and younger people happens to be Robinhood for a reason. The interface is beautiful. Now, compared to the other stock interfaces that I've used, broker interfaces, this is the best one. It's so easy and simple to follow. The goal with trading stocks is to buy the stocks that you're interested in and then sell it. Okay. You want relevant information, some recommendations, and I will admit it's pretty sparse with what you get, the information, but it's adequate to make a good informed decision. It lays it out very nicely, easy for you to see different trends. Now, that's the one I personally use the most. I just opened an account with Webull recently, and it made me just realize how good Robinhood's interface is. I prefer it so much better. Webull does have, it looks nice. It looks nice, but it can be quite confusing. There's a lot that you have to navigate and dig through before you get to the information you want. Unlike Robinhood, where it's just right there in front of you, ready to go. So that's one thing I do like about Robinhood versus Webull. While Webull is nice, they do have some of the benefits. I still haven't figured this out yet, how to do it, but apparently you can do after-hour trading. That's one of the reasons that I actually, went over to Webull. I'm still trying to figure that out. So if you know, let me know in the comments. But Webull and Robinhood, those are my primary trading accounts. They work best for me. The interface is the best for me and what I know, my level of trading confidence and experience. Some of the other platforms are great as well. And you can go with whichever you want, but those are the ones I use. There's a link. You can get a free stock with it if you sign up through my link. It also helps me out, but do however you feel like. Number 3, go together. So this is quite important and something that I did a little bit of in the start, but I do a whole lot more of now. Trading is a fun experience for me personally. I think of it as a game. It's not really, it's one of the most fun ways to make money. And when you do make money of it, when you do make a gain, it's quite exciting because you feel like Nostradamus, like you're predicting the future or something. It's quite cool that you're able to put money into something, you see a vision and you're able to invest in that and then see it grow, and with your money growing as well. It's quite exciting to see that. So for me, investing and stock trading is something that I take pleasure in, and when you have other people in the process with you, it's so much better. So some of the communities that I currently follow right now is Reddit. I call them the Reddit boys. Shout out to the Reddit boys. If you're in there, if you're watching this video, drop a comment. The Reddit boys, I'll put some links to some of the Reddit trends that I follow. But Reddit is entertaining. The people on there, they're funny. But not only that, but they give you good, solid information. They give you tips and different plays that can help you further advance your trading skills and look at new companies that you might not be aware of. There's so much benefits to going together and working with other people, or just going through the process with other people. Plus, it can get lonely if you're just on your computer trading by yourself. Having that interaction with some other people, or just reading the comments, makes it a little bit more interesting. When you're up, you get to celebrate with everyone. When you're down, you guys can, complain about it together. There's pluses and benefits to it. The other reason why I love going together and why I'm doing this now is that you can learn so much from other people. I didn't have this when I started trading, and a lot of the trades I was doing was just based on my own experience. So the lessons I had to learn were firsthand, which are good, nothing wrong with it, but you can learn secondhand by other people who are making different trades and different strategies. You can see how their strategies work. With these internet communities, they're very active and very open, willing to speak and about their experiences and what they're going through. And it makes it a great opportunity to learn and see what trade patterns work and what strategies work. Like I mentioned, you can learn about new companies that you might not be aware of. It's overall such a great experience to just improve your trading skills and also make it more enjoyable. So those are the 3 decisions that have really helped me to trade better and optimize my trading experience. All right, of course, trading is not perfect. It's not all daisies and sunshine. It's a lot of rain and sadness and tears. Oh, a whole lot of tears. But there's good in it. And with the good is that you get to learn from those mistakes. A lot of my experience trading, while I just, and shout out, I just finally broke even on my trading account from a few recent plays that I've did. So I'm quite excited about that. But through the process of the downs and the negatives, you do learn a lot. You come out as a better trader. And here are three mistakes that I made that hopefully you don't have to make as well. So for the first one, not starting early. I started trading when I was 23 or 24, and I am currently 28. So I started out, I could have started out when I was in college with any money that I got. I could have put that on the side. Once again, that story of the person who bought Amazon when it was $1. Yeah, the stories are kind of ridiculous and clickbaity, but the point being, you want to get in early. If you have any extra money, don't be hesitant with it. If you can afford it, put that money into the stock market. That's something that I did not do, and something I wish I could go back and do, because I would have been set up a whole lot better and would have been able to get into some companies where I truly believed in them and I was seeing them develop. I could have gone into those companies a lot earlier and kept that money there. So that's something that I would recommend if you're younger. Take that opportunity and get into the trading business. It's never too early to start. Number two is not doing due diligence. So you might see this called DD online. Due diligence is just where you do a thorough analysis and inspection of whatever company it is that you're looking at trading or investing in. You do a thorough analysis and see what the company is about, why it is worth investing. You want to invest in good companies, look at potential news that's coming out for them, and that helps you give you a better idea and gives you more information that you can base your investment on. Hopefully the news is all good and that gives you more confidence to invest in that company. If it's not so good, then you know which companies to avoid, and then you can also make smarter decisions. I did not do this so much. My very first stock I got, luckily, it was something that I believed in. It was an Intel. Now, I'm very big into technology, as you guys have seen. One thing that's guaranteed with tech is, especially high-end technology, Intel is involved in there. All the computers, all the high-end computers, whether it's Mac or Windows, Intel is involved. And I was quite confident in their future and that they were going to be profitable. So I went ahead, easy decision. It's something I knew. I went ahead and invested in that. So that was good. I really didn't look too much into their earnings report or future prospects. I didn't do anything crazy. It was more of a gut feeling and just more of my real world knowledge and experience with what Intel does. So that's what helps. And it came out well. You can do that and that's fine. Where due diligence, I didn't do due diligence, was for another company, United States Oil. I had no clue what this company was about. Someone just told me about it. I went, well, it's oil. Everyone's always going to need oil. So I'm pretty sure it's going to go up. So I went ahead and bought that company. Also Clean Energy. It's another company. I bought this way back when I first started trading. And those companies tanked. I lost money on them. He just kept going down and I was so upset. I held on for them too long and I lost a good amount of money. Whatever money I made on Intel was pretty much wasted on those other companies. I didn't do my due diligence on those companies to really, understand why I should invest in them or how long I should hold on to that investment. So that was one of the lessons that I learned. I wish I knew earlier, but hey, you live and you learn. So number 3, I saved this one for last because this is probably the most important one. I almost want to make a full video for this. I might, but you need to have clear rules. If you don't have clear rules, you will be in so much frustration and you will just hate trading. You need principles. Trust me. I've made a lot of trades off of, for whatever reason, poor reasons. But really, you need clear rules because that's going to guide you on when to make that purchase and when to pull out and sell. So specific rules that you want to think about is a buying point. When do you buy a company? Do you buy them when they're on the red, meaning that they're slowly going down, or do you buy them in the green when they're going up? Having that rule helps you know when to execute a trade. It makes it a lot easier. Also, when you should sell. Knowing when to sell is very important. Do you want to secure your gains that you've made, your profit, or do you want to just hold on for a longer time? And this becomes very important in times of volatility or if you are dealing with different types of holdings. So when I say that, for specific types of stocks that you might buy, you might be buying them thinking that their potential is 10 years from when you buy them. For example, Tesla. Tesla is still in its infancy, but 10 years later, who knows what they're going to look like. So you're buying for the future 10 years, what that company is going to look like. Not necessarily today, 1 month or a year, even though that might look positive, but 10 years. Versus a company where, like let's say Disney, they announced Disney Plus, you're looking to just make a quick flip on that. So you hear that new announcement, so you go ahead and you make that purchase. Well, that's a shorter term purchase. Disney is still good for the long term, but if you're making that decision based on short term information, you want to have that clear, because how you trade that company is going to be highly dependent on that. And one of the mistakes that I made was that, for example, I sold shares of Tesla and also Apple way too early. I freaked out. I had no clear rules. Tesla and Apple are pretty much long-term companies for me. 10 years, I'm looking to hold on to these companies. And I sold them within like a year or less, something like that, because they had some fluctuations here and there. And I freaked out and I sold them. And looking back now, the amount I got it for way back then compared to what it is now, if only I had stayed in. And it only makes sense that it's the price it is now, because the future trajectory for those companies, it's all positive. They're one of the leaders in their industry. So it makes sense to hold them long term. So I was selling long-term stocks, treating them like short-term holdings, which I shouldn't have. And the other part is that I held on to short-term stocks for too long. Stocks that I was intending to hold for a few months, maybe a couple of months, I held on to them for way too long, up to a year. Those two stocks I told you about, Clean Energy and USO, I held on to them for like maybe a year or two. Those are, now I did have a long-term view on them, but I should have sold earlier. So that goes into the rules as well. But also, if it's a short-term stock, you're looking to make a quick flip on there, don't hold it for past the time that you make a time frame, and just don't hold it past that. Okay. That will help you out so much. So I'll leave it at that. Those are the 3 decisions that really helped me trade better as an investor. And then those are also the 3 mistakes that I learned through my years of trading. I hope it helps. Once again, check out those communities that I mentioned in the description there. Drop a comment on this video and let me know which trades you're doing, which plays you have. And let's all do this together. Right now is a really opportune time. A lot of companies are way down in their value, and this is a good buying point. This is a time to really get a discount on a lot of these companies. So I encourage you, get in, and don't look back. Just keep going. You're gonna do great. All right. So I'll check you out later. Drop a comment, leave a subscription. I think that's how that goes. Whatever the case may be. And I'll see you on the next one. All right.